going to go ahead and get started. I hope everybody had a great New Year's and a blessed holiday season. I am so excited to do this webinar, and we're going to take a look back at everything that occurred in 2023, which was a lot. There was a lot of economic movement, economic news. I want to dive through in detail some of the things that you hear about on the news and give you a little more education on that and a better understanding. And then we're going to take a look ahead and say, what do we need to navigate through or maneuver around in 2024? And I'm excited to share that. So my name is Tyler Braun. I'm the Director of Financial Planning here with the Tranel Financial Group. Many of you that are on this call work with myself or have worked with our team over the years. There's some new on this call as well, but it's a pleasure to meet each and every one of you. So with that, let's get started here. I always like to start with an agenda, and this is the same agenda we've used the last year. It's really looking at where are we at right now, what's going on, what do we need to be aware of, what do we need to game plan for, and then looking ahead, how do we navigate those obstacles, just like I talked about. And with that being said, right, with change and volatility comes opportunity. And last year we talked about some opportunities that were coming to fruition for the first time in the last decade with rising interest rates. And now with interest rates possibly changing tide here, which we'll talk about, there's going to be new opportunities to capitalize on and make sure that we're staying abreast with. So we're going to go through those in detail as well. So with that being said, also want to remind you, this is a live webinar. So if you have questions at the bottom of the screen, there's a Q&A button. So Jenna Bradford, who's the president of our company, is on here as well. So if you do have questions as we go through, simply click that Q&A button. You can type your question in, and we'll make sure we cover it at the end of the webinar and go through it in detail with you. So with that being said, remember, with change and volatility comes opportunity. That's the lens that I want each of you to look through as we go through today's webinar. So let's talk about what's going on. So interest rates are changing. So for the last 18 months, interest rates have risen at the fastest pace in U.S. history. And they did that to combat inflation. We'll go through this more in detail. We're starting to see the tides turn, right? We're getting towards the top of that bell curve, and we're now starting to see, different indications, especially the Fed coming out and saying they're looking to pivot and start decreasing rates already in 2024. We continue to see world unrest, right? Ukraine and Russia continue to go head to head. And the United States has, continued to fund Ukraine over the past year. And now you look at Iran and Israel and Gaza and all these different pieces that are really shaking things up from a world standpoint, something we need to pay attention to. You may hear things in the news about a governmental shutdown due to the spending that we've had. We're over $34 trillion in national debt currently. We're going to talk about that. And then you see in bold letters, right? It's an election year this year, but with an election years comes opportunity as well. So let's take a look back first. And really last year, right? It's weird even saying last year, but 2023 was a tale of two stories. So when you look at the end of the year, you can see the past 1 year performance for the S&P. The top largest 500 companies in the United States were up just under 23% over the past 1 year. And as you can see my cursor moving here, right, you can see the fourth quarter was a hockey stick up. We had some volatility that occurred in the third quarter, but really from a standpoint of the S&P being up 23%, that's a really good year, right? You say that's a great year. And, as we look at those pieces, it was a year of recovery. And that's something we're going to talk through more in detail, growth versus recovery. So remember back in 2022, the market was down about 18.2% year over year. So 2023 was a year of recovery. And when we start to look where the volatility came from, this is the lens I need you to educate yourself with. Because if you listen to the news, they say, oh, the market was straight up. No, the market is recovering and had recovered in 2023. So if we date back to when the volatility actually started, which was the end of 2021, beginning of 2022, you can see the sell-off that had occurred in the S&P and the recovery that we've seen in 2023. But during that time period, even with the market being up almost 23% in 2023, you can see it's still basically flat since the beginning of 2022. So since the beginning, or January 1st of 2022, the S&P is literally flat across the board, meaning that he went down in 2022 and recovered in 2023. So as we look at that and we digest that and we hear that growth versus recovery story, right? This is directly off of Yahoo News. It was a clip right at the end of the year, and I thought it was very interesting. Almost 75% of the S&P 500 stocks last year underperformed the market. So think about that. The S&P is up 23%, but 75% of the stocks in the S&P underperformed the market. Right? You think through that and you say, how does that work? Well, the top 7 companies, and we've talked about this before, the top 7 companies in the S&P are Facebook, Apple, Amazon, Netflix, Google, Microsoft, NVIDIA. So they're nicknamed the Magnificent Seven. Those 7 companies make up over 28% of the S&P, because the S&P is what's called cap weighted, which means it's not an equal percentage of all 500 companies in that index. The larger companies represent a larger percentage or cap weighting of that index. So those top 7 companies were what were sold off dramatically in 2022 and had an exponential recovery in 2023. And what that does is it drives the index higher, even though 75% of the 500 companies underperformed that. So let's look at this a little further in detail. So this is Meta. Meta is the holding company for Facebook. In 2023, Meta was up 216%. Think about that, right? Everybody's like, I want that, right? Who doesn't want to be up 216% in a year? So if Meta is one of the top 7 companies in the S&P, meaning it represents a large percentage of the S&P, that is going to drive the performance of the index up, up, up. Now, the issue is when we take a further look at it, you have to ask yourself the question, is it growth or is it recovery? Because remember, 2023, the theme is it was a year of recovery, not necessarily a year of growth. So being up 216% in 2023, if we take a step back further, you can see since the volatility started in 2022, Meta, even being up 216% in 2023, was actually only up 1% since the volatility had started. And you can see where I'm describing that recovery term versus growth term. Technology sectors in particular, right? These big 7 companies, Amazon, right? Google, Microsoft, etc., had a huge sell-off in 2022. And you can see it represented on this chart, how Meta fell exponentially. Remember, if you're compounding on a smaller number, you have to have a bigger return from a percentage standpoint just to recover to get where you were. So that's why with Meta even being up 216% in 2023, they're only up 1% since the volatility started. So growth-wise, they have not had significant growth over the last 2-year period. Great 2023, but it was recovery. And where I get frustrated is I don't feel that society as a whole does a good job of educating that. What they do is they talk about returns in percentages, and that can get skewed. We have to take into account what is the true growth of a holding versus what is that short-term upside when we just look at a small blip on the radar. So you can see reflected here, since 2022, Meta is only up 1.15% as true growth, which is not exponential whatsoever. So what I did in comparison is I pulled up another company off of the S&P. So this is McDonald's Corporation. I'm sure all of you know the Golden Arches. And as we look at it last year, Okay, last year, so the year of 2023, McDonald's was up about 12.89%. So this is one of those companies that we alluded to at the beginning of the presentation that had said, okay, it underperformed the market, right? The market was up 23% in 2023. Here's McDonald's, which is a great company, up 12.89%. So that underperformed the overall market, up 12.89%. This is the difference, though, between growth and recovery. As we look at the next slide and we look at when the volatility started, which was 2022, we just got done talking about Meta, which had a great year in 2023, but was recovering and is only up 1% over that time period. Here we look at McDonald's Corporation, which was only up 12% last year. And you can see they have almost an 11% return since the volatility started in 2022. That's growth, right? So think about that. That's pure growth. So even though they didn't have a 200% recovery, they didn't have the same type of sell-off because of the holding they have. And they were able to achieve literally a 10% higher return over that same time period, even though they didn't have that sexy return in 2023. So remember, recovery is what we saw from the tech companies in 2023 that led to the upside. The pure growth that we have to take a step back and look at when you measure it is very interesting when you start looking under the hood at the different corporations and different companies that are out there. So just thought I'd share that example. I know that's a little in the weeds, but I always find it very interesting when you look at that, how the market is reacting one way, but here we are looking at it saying 75% of the companies actually underperform the market, but a lot of those companies actually had higher growth over that period of volatility than these magnificent seven that we were talking about previously. So let's shift gears here and look ahead. As we talked about before, right, interest rates are going to be decreasing. There is a world of unrest out there, governmental shutdowns, election years, all these different pieces. Let's start unpacking these. Let's take a look further in detail and say, what does that mean for you as the consumer, right? How does that impact you on your day-to-day? So for a long, long time, I used this slide, and it was increasing interest rates. So over the last 18 months, right, prior to November, interest rates had been increasing at the fastest pace in U.S. history. So think about that. You just lived through the fastest interest rate increase in U.S. history. What that means is they raised interest rates because inflation was at a 40-year high. 2 years ago during July, or 2.5 years now, during July, inflation was at 12% year over year. The CPI index, the consumer price index, was at 12% increase year over year, the highest since 1970. And the Federal Reserve was worried that they would set in hyperinflation, which is bad for the U.S. economy because things just get out of hand. Expenses go up, 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 and the value of the dollar decreases rapidly. What they do to curb that is they make things more expensive. And it sounds crazy when I say it, but they make things more expensive on purpose. So everything is driven off of supply and demand. So by increasing interest rates, what they're doing is they're making loans or access to money or access to things more expensive, right? If you go to buy a house and you have to pay a 7% interest rate instead of a 3% interest rate, you're paying more interest to the institution, which means it costs you more money per month. You have less money left over out of your paycheck or out of your disposable cash flow to buy items, which means your desire to buy things comes down, and that way the price starts to come down, right? If you go to a car lot and there's one car available and 100 people want to buy it, price goes up. If you go to a car lot and there's 100 cars and one person wants to buy a car, you're going to get a sale, right? They start to blow out that inventory or reduce the cost. Now, we have started to see the cost come down. What's interesting about interest rates is it takes 12 to 18 months to work through the economy. It doesn't just happen overnight. And that's where the market starts to price it in overnight. If you hear interest rates in the news, market could react positive, it could react negative, just like that. But the overall economy, it takes time for the interest rates to work through the system. So, for example, in that mortgage analogy or example I just used, if mortgage rates go up, it's not going to impact people for at least 90 days because it takes a period of time for closing. And most people that were already buying a house had locked in the interest rate at that lower level before it went up. So it takes a longer period of time to work through the system. And it also takes a longer period of time to work through their cash flow. People don't realize the price increase until they start to deplete their savings. And then they say, oh my gosh, I have to change my spending habits because I don't have that safety net there anymore. And we're starting to see those spending habits change. So credit has become more expensive. That was raising the interest rates. On the right side of my screen, you can see that the Federal Reserve came out at the end of November, and this is the first time in almost 2 years, and they said we're projecting rate cuts for 2024. So that's going to change things. And the reason I say it's going to change things is if rates start going down, we have to pay attention to that in a different way, right? So a lot of people were able to take advantage of higher interest rate bearing CDs, money markets, more secured investments that don't subject their principal to risk, but pay a nice yield. Those are going to start to lose their luster. And as they lose their luster, alternatives to those start to become a little bit more attractive to investors. They call that cyclical shift. I'm going to talk about that here in a second. So just note that the Federal Reserve is anticipating to cut rates this year, not increase them. You may ask yourself, why? You have to remember, they are the ones with their pulse on the overall economy looking ahead, and they're saying, we're now starting to see that 12 to 18 month cycle of the interest rate increases working through the economy. And we know that the economy has continued to slow in the short term, and they're looking to start to jumpstart again. And they're looking to achieve what's called a soft landing. So a soft landing is a term that was made up by the Federal Reserve to describe increasing rates to slow the economy and then cutting rates to spark the growth in the economy. That's what they're trying to achieve. But just note, we're seeing the economy and this consumer spending decrease. And with that, the Federal Reserve is starting to cut interest rates now, and we need to be prepared for that, which we are. And we'll talk about that more here in just a second. So I used this term before, just a second ago, called cyclical shift. So what cyclical shift is, last year, we just described this, right? The top 7 companies, Facebook, Apple, Amazon, Netflix, Google, NVIDIA, Microsoft, they're all technology companies, right? They're growth type stocks. So we saw growth type of stocks take off last year. When interest rates start to decrease, what we're seeing is a cyclical shift, which is a nerdy term. That means we're seeing companies that were not necessarily underperforming last year, but didn't perform the same way that the growth stocks did. They start to become more attractive to investors. So as you can see on the right-hand side of the screen, this is just an ETF. It's a Vanguard Value ETF. So it's value-based companies. Value-based stocks and companies are companies that not only appreciate in stock price, but they also pay an attractive yield or dividend to their consumers, right? A lot of clients I have are from Abbott, AbbVie. They're known value companies, right? So as we look at that, value companies start to become very, very attractive as interest rates decrease because consumers start to lose that safe haven of being able to get interest to live off of or to reinvest or to gift or to whatever they're utilizing that interest for that was generated off of that CD or savings account, etc. As that begins to decrease, consumers have to look elsewhere to say, where can I get the income that I need for my lifestyle? Dividends are a great way to do this and capture capital appreciation as the market starts to recover over time. So as we look at those pieces, what I want to note on here, and I'm circling this, is you can see in October, right when the Federal Reserve started to come out and announce that they're looking to decrease interest rates next year, you see just like that, the market starts to price in value companies bouncing and doing much better. And you can see the hockey stick growth that occurred in a matter of a month and a half to 2 months now, right? These value companies are up on average, and you can Google any of them, right? Waste Management, McDonald's, any of those value type companies, and you're going to see literally the exact same thing I'm showing you right here. You see a huge hockey stick up as soon as the Fed made the announcement that they're looking to cut rates in 2024 because we're seeing that cyclical shift. These value companies, this ETF was up almost 13% in 2 months, when prior to that was negative for the whole year, right? It was actually negative in performance up till October, was up 13 months just like that. So it's a great lesson that you're buying good, solid companies for the long term. And we're always going to go through cycles. Yes, we want to be on the forefront of those cycles to make sure that we're being as efficient as possible. But we're seeing that cyclical shift now as we're anticipating interest rates to drop. That's a big opportunity. That is a very, very big opportunity to look at and say, as rates decrease, hey, there's some of these companies are very, very ripe for continued growth with the way that they've been positioned over the last few years. Next piece that we're going to touch on here is a governmental shutdown. So you're going to hear this a lot. They just pushed a bill through the government last night, which was another stopgap or a short-term bill to keep the government open. We have a lot of friction in politics right now. So you think about it, the Democrats and Republicans don't get along whatsoever. There's a lot of infighting, even between the Republican side or the Democrat side, on how to get things done. And here we are stuck in the middle. So just remember that a governmental shutdown is not a default. Do not let this scare you. Okay. As they throw that term out there, the government has shut down over a dozen times in the last 20 years. They're temporary shutdowns. They keep the essential employees on staff. They'll furlough the employees that they do not deem essential, meaning they don't have to be open to keep the government in business. It's an inconvenience, but it is not a default. Okay, a default is what we talked about last June, where the government was, if they didn't pass certain things, they were going to miss interest payments for the first time in United States history. What we're talking about now is a shutdown. Basically, it's they have a sum of money coming in. It's how do they want to spend that money and what do they want to put forth with their budgets? And that's what they're fighting over currently. We're going to continue to see this, right? We are going to continue to hear about this and see this. The market prices in short-term volatility with it. But quite frankly, if you're holding good companies, right, if the government shuts down and for a 3-week period, right, you're probably not going to go to Walmart less. You're probably not going to do certain things. You're still going to need Kleenexes. You're still going to need toilet paper. You're still going to need the things that you live day to day. And for a person that's not associated with the government, you're still working day to day. It doesn't have as much impact because it's not a default. It's a shutdown. I don't necessarily know that we'll even see a shutdown. They continue to pass these short-term stopgaps. So you can hear it, but don't lose sleep over it. That's what I'm sharing with you. Do not get overexcited one way or another as you hear these different things. The world unrest piece. This is, Ukraine and Russia continues to be in the forefront of most people's minds as they continue to, be at war. And, we're pushing close to 2 years here of them being at war with each other. And now you see one of our allies in Israel, invading their neighbor due to some terrorist activities and so forth. We have tried to stay, when I say we, the United States has tried to stay at an arm's reach because we don't want to get into direct contact with Iran, right? Wars and territorial battles and so forth are expensive as a nation. We don't want to see people die that don't, innocent people pass away or anything like that. No one wants to go to war. But you have to remember, you and I have no control over this. We have no control over it one way or another, and we need to remember that. And it's that same mindset that I just talked about with the governmental shutdown. We don't have control over the actions. We need to invest in good, solid companies and insulate ourselves from volatility and make sure we're positioned correctly for all of these what ifs, right? I don't know if there's going to be a war. I don't know if there'll be a terrorist activity. I don't know. But what I do know is we're investing in really good, solid companies, and you're going to be okay regardless of what the outcome is. If we did go to war, did not go to war, did see those different activities, we need to insulate ourselves from those activities, and that's what we can control. So just remember that. It's an election year. An election year, right? I've been hearing about this all the time. So on the left-hand side of the screen, there's two things that we can know with high probability. Number one, bad TV commercials. Think about that. They're starting already. I am sick of them, and it's not even the third week of January. We're going to have a lot of bad TV commercials. Number two, volatility in the market. There are typically, we see an increase in volatility during election years because there's a lot of white noise, meaning a lot of noise that's just thrown at us. And people and institutions can overreact to that noise, both positive and negative. But it's not always bad. It really isn't. So if you look at the screen, this is every election year since 1928. Most years during an election, the stock market is positive. So think about that. All the elections, 83% of the time over the last 24 elections, the market's been positive during that year. But there's been a whole lot of volatility that occurs during the year. That's where we need to manage our emotions. If you said, where do most investors fail? They get out at the wrong time and they get into the market at the wrong time. So what I mean by that is they're selling at the lows and they're chasing the highs. And, Warren Buffett always says it best, right? He says, be fearful when others are greedy and be greedy when others are fearful. So when most people are looking to jump out of the market because there's volatility, that's when you should be getting in. And when most people are saying, oh, I got to put more and more in, this is great, and they're seeing this euphoric type moment, that's typically where you need to start pumping the brakes and being more cautious with your investing. Okay. So election year, 83% of the time actually ends in a positive return. Obviously, we don't know what this year will bring, but there will be plenty of volatility in the meantime. So I bring up that term volatility. Good news and bad news can drive the market very, very quickly. I just talked about cyclical shift previously, where we see interest rates coming down. Just the news of interest rates decreasing caused the market to spike. That's all it took. Just the news that interest rates are going to decrease. They haven't even started to decrease the interest rates yet. And we've seen the market and those more value-oriented companies start to hockey stick positive. So the reason I put this snapshot on the presentation is you need to continue to look back and stay long-term with your mindset. If you sold during any one of these volatile moments, you would have missed all the upside that occurred in a short period of time. And no matter how long you look back in the market, right? Think back to, 07, 08. If you sold at the bottom in 07, 08, you would have missed one of the greatest return decades, in the history of the S&P, in the history of the market. So you need to continue to remain persistent and long-term. You are an investor. You are not a gambler. You are not a day trader. You are an investor. You are investing in companies that are going to be there for a long period of time. And that's the key word. You're investing in companies, not investing just in a one-day return or a one-quarter return. You're investing in it for the long term. Now, at times, you're going to want to switch the company you're invested in, just like any good investor. But overall, we need to continue to have that long-term mindset, because an election year is one little spot, right? One little spot on the radar of a much longer ride for you as an investor. Okay, so there will be uncertainty, there will be volatility. It's an election year, right? It's going to happen. So key takeaways here. If you got a pen and a paper out, these are where you're going to want to start writing things down, okay? Interest rates have impacted inflation for the positive. We're seeing inflation coming down. The hard part with inflation, right? The hard part about inflation is it's like a stair step. So I always use lumber as an example. So think of a 2x4. Anybody who does building, remodeling, works with wood, a 2x4, if you went to Menards prior to the pandemic, was about $1.49 for an 8-foot standard 2x4. If you went during the pandemic, that same 2x4 was almost $9 in cost. So it went up 900%. Right now, if you go to Menards, a 2x4 is close to $3. So we're celebrating, right? And the administration in particular is celebrating because it went from $9 down to $3, and they're saying, "Hey, this dropped 300%." The problem is it's still up 250% from where it started, and that's how inflation works. It spikes, it decreases, and then it goes, spikes, decreases, but it's a stair step. It continues to get higher and higher and higher, and that's where many of my clients are making comments saying, "Hey, things are more expensive now than they used to be, and they're starting to feel it." That's the key word. They're starting to feel it. You go to the grocery store, it does not take a whole lot, right? You got 3, 4 items in a bag, and there's $50, just like that. Okay, so be aware of that we're starting to see consumers change their spending habits, meaning that the economy is slowing down. GDP is projected to decrease, and that's why they're starting to decrease interest rates because of that. They want to decrease interest rates because the Federal Reserve is seeing that the economy is slowing, and they want to make sure that they don't drive it anywhere further down than it needs to be. So they're trying to jumpstart that and get ahead of it. But be aware, people are changing their spending habits. We need to be aware of that from an investment standpoint. Okay. Low risk investments are still yielding some attractive rates, but they're starting to lose the shine. So think about that. A CD 3 months ago, you might have been able to find 5.5%, 5.75% for a 1 year, an 18-month CD. Those same CD rates already have come down to 5.25%, 5%, somewhere in that range, maybe even lower. And the reason they're doing that is banks know that interest rates are going to come down. Institutions are not going to pay you or don't want to pay you for 2 years a higher rate than what they're able to receive with interest rates dropping. So we're going to see those products start to come down. Opportunity is if you have a CD come due or you're looking to put something in, look for a little longer term. Look for a 12-month to an 18-month, because with high degree of certainty, we're most likely going to see rates lower 12 months from now than they are today, and you're able to get a little bit more of a return during that period if you're utilizing some of those. Treasuries are the same way, right? We've been locking in some higher treasury rates for a longer period of time just to take advantage of treasuries being at an increased value currently. Focus on the long term. We talked about this before. Election year in particular, I put on here, don't chase the shiny object in the news. So think about it. If you've held Meta or you've held Amazon or you've held any of these companies the last 2 years, you've had no growth, none, right? You've had literally, you're flat across the board. Meta's up 1% the last 2 years. It was up 200% last year, but that's because it was down so much the year before, right? So as we look at those pieces, don't chase that. We're looking for true long-term growth. Think of that McDonald's analogy or McDonald's example I showed, where it's up almost 11% during that same time period and was only up 12% last year, right? So the big volatile swings over time can be to your benefit, but a lot of the people on this call are more in that pre-retiree or retiree state. We don't want to see huge volatile swings. We want true growth. I always joke around, right? We're trying to hit singles and doubles because we know we're going to win the game versus trying to hit the home run and hoping you don't strike out, right? We want to hit singles and doubles and win. So we got to look at using assets differently to take advantage of the volatility. As that cyclical shift is occurring, right? As these dividend paying companies, which a lot of you hold, are starting to gain some luster, right? We're seeing that hockey stick since October, which is exactly what we want, right? Remember that dividend helps insulate your cash flow, right? Dividend's a form of yield, the amount of income that can be generated without touching the principal, right? So if you're taking a 4% distribution out of the account and your dividend is 3.5%, you're only forced to touch 0.5% of principal, and over time, you're darn sure going to be pacing that distribution. So it limits how much principal you have to take, having that additional income stream in there. And a lot of clients are just taking dividends out And if you're only taking the dividend, you're really not depleting any shares of principal, which means you can wait for the stock price to appreciate. And now you're starting to talk more about that generational wealth that can occur and handing those shares down to the next generation if that's your goal. So some of the opportunities we're seeing here in the short term, okay, cyclical turnover, we just talked about that. There's as interest rates decrease and continue to decrease, more value-based companies that pay a dividend will start to be that next uptick or upcycle that we're seeing. Okay, that's a cyclical shift that's occurring. Roth conversions are always something we want to pay attention to as well. We'll do a webinar on this in the future. But with Roth conversions, what we're looking at is, the Trump tax cuts that were put in place are set to expire in 2026. So it's called sunset, which means if they don't change anything, we're going to see taxes go back to what they were under the Obama administration, which is about 3 percentage points higher than where they are right now. So what we're seeing is an opportunity here between now and 2026 to possibly do some conversions at a lower tax bracket, because if you're going to pay taxes, we'd rather pay as little in taxes as possible. That does not make sense for everyone. I'm telling you that right now. It does not make sense for everyone, but for certain people, it absolutely makes sense. Look at reallocating some assets for the future. So remember, if you held something that was sold off heavily in 2022 and has now recovered nicely in 2023, now's the time you look at reallocating, right? Because you're not selling at a low. It's now recovered more towards its high. Let's look at reallocating and taking advantage of different things for the future with some opportunities. And then continue. If you have extra funds, continue to invest through volatility. The best thing you can do is just continue to add, right? It's called dollar cost averaging. So if you're adding to your 401k or you're putting into a Roth or just an after-tax account, adding systematic contributions allows you to purchase at different points into the market. And then you acquire more shares and your average share price decreases over time. As the market goes up, you see bigger gains. So you're really positioning yourself saying, hey, if we see volatility and we see a dip, you're buying at a dip. If the market's down 10%, it's like buying it on sale for 10%. If you went to the store, right, you see a 10% sale, it gets you excited, you want to purchase. It's the same thing with the market. It's just hard because no one likes seeing that volatility, myself included, right? But we want to make sure we're continuing to purchase and invest for the long term. So in overview, inflation is easing. That's a positive. Interest rates are decreasing, but they're decreasing because we're seeing the economy start to slow because consumers are changing their spending habits, and there's still a lot of uncertainty out there. Be aware of that and be prepared for that. So as we've talked about before, the secret to success is you want to focus on companies that you're going to need the product regardless of what the cost is or the market is occurring or what's occurring in the market. So invest in good, solid companies you're going to hold for a long period of time. Know that you're positioned properly inside the account from a risk profile and from an investment profile, especially with the cyclical shift. Focus on the long term, add to the accounts, and then when you're pulling dividends or income, you want to insulate yourself as best as possible where you don't have to worry about all the garbage that's occurring out there, and you know that the income is going to be there month to month because you're living off of the income, right? That's the biggest piece, right? Cash flow is king. You're living off that income. So with that being said, I'm going to stop my share here. Jenna, do we have any questions at all that have come through from anyone that we can go through? Oh, I think I cannot hear you, Jenna. There you are.
I'm muted. I apologize about that. One of them that already came through, you answered live, so thank you for being proactive from that standpoint. But we have a second question that's come in. It says, how do geopolitical issues affect global companies we're investing in? Are our investment fundings these wars, and the multinationals do contribute to governments across the world that favor their business?
That is a loaded question there.
It is.
So I'm going to break that down into pieces. What I'm hearing from the question is, okay, are our investments into these companies funding these wars? Okay, I'm going to start with that. Not necessarily. So what I mean by not necessarily is companies are not directly contributing to these efforts or wars. Yes, certain companies or certain institutions might have a vested interest in an outcome. So think about it. If you're in the farming industry and Russia continues to invade Ukraine, and Ukraine's one of the largest wheat producers or exporters in the world, that changes
Mm-hmm.
things, right? That changes that market. So companies that are in that
Right.
market would have a vested interest of what's occurring. So what they're doing is they have lobbyist groups that are then going to Capitol Hill, and they're trying
Mm-hmm.
to sway our politicians one way or another in that company's interest. But taxpayer dollars are what actually go towards the funding. If you see the United States is giving aid to Ukraine or aid to these different countries, that's coming from our taxpayer dollars through the budget, and they're doing that through defense spending, or they're cutting other things to give that aid, and they're saying, it's for the good of the people and the protection of the nation, etc. So it comes from taxpayer dollars, not from business dollars. So
Mm-hmm.
I hope that answered that question. If they have more specific things, we can go through that together. But taxpayer dollars are what are paying for the aid, not company donations or anything like that.
I think from a high level point of view, that did answer the question. I would agree with that. If that person would like to ask anything more in depth, they can absolutely reach out. However, though, that was the biggest question that we had that needed to be answered on here. So at this point in time, if anyone else has any further questions, feel free to call or email in, and we're happy to have a further discussion with you.
Yeah, appreciate everybody being on this call. We'll do more of these. And just like Jenna said, if you have questions, that's what we're here for. We're happy to help. So hope everyone has a great rest of their day, and I'll talk to everybody soon.